Let's talk about the auto space now. Motilal Oswal has written an interesting report where they talk about how the automobile sector is back from the brink after 5 years of a downturn. The going was not good for a long stretch, but now things are improving, headwinds are receding, demand is moving up. So let's find out what the way forward is. Jinesh Gandhi, who is one of the co-authors of the report, joins in to talk about that. Jinesh, good morning and thanks for joining in. Can you tell us, in terms of, all of the tailwinds that you speak about in your report, whether it is receding cost tailwinds, favorable mix, favorable forex, as well as an improvement in demand, which is the biggest beneficiary here on, both in terms of valuation upside as well as growth upside?
Hi, good morning, Sonia. So clearly from the tailwinds going forward, we clearly see upside to the demand side, which in turn will also be a driver of operating leverage for most of the companies. Along with that, stable commodity environment is also going to support the margin improvement for the auto sector. Broadly speaking, if you see, we are seeing margins recovering from the lows. If I compare where auto sector margins are today vis-a-vis long period averages or last 10 years averages, we are still well below the normal margins. The range was about 12.5% to 15.5%. We expect it to go back to about 13.5% by FY25. So the only factor to watch out for is how commodity prices behave from here on. We have seen some inflation. Unlike last 2 years where it was hyperinflation, if we see a normal inflation, it should be very well manageable, given demand is reasonable and pricing power is also fairly good for a large part of the auto sector.
Jinesh, hi, good morning. So if we look at your growth expectations, I guess the commercial vehicle space is what you seem to be most optimistic about, though you're expecting good growth even in passenger vehicles. And now apply that in terms of then picking the right stocks. Would you, let's say, go with an Ashok Leyland over a Maruti? And how does it boil down to stocks?
So on relative basis, what you're saying is absolutely right. We prefer Ashok Leyland over Maruti. Ashok Leyland, given it's a pure play on the commercial vehicle space, we see continued traction on the CV demand. Clearly, there has been a good amount of pent-up demand, which is yet to come in form of replacement demand. Along with that, there could be potential benefit of scrappage policy, which will be implemented from early FY24. So that also could be potential factor, which is not part of our estimates. So if that comes in, that will be additional driver of demand, obviously what we are building in for. More importantly, it's a clean play on the GDP activity. So from that perspective, Leyland clearly is one of our top ideas in the overall auto space. Add to that, the margin improvement story is just starting. After seeing a good recovery in demand and market share, we are seeing margin as a lever coming into play for Ashok Leyland now. We do believe close to 10% margins are easily doable for Ashok Leyland as volumes pickups and operating leverage fully kicks in. So hence, Ashok Leyland is our preferred OEM play in the overall automotive space.
Okay, Ashok Leyland is a preferred OEM play. Got that. Your other stock that you like, one of the top picks in the sector is Mahindra & Mahindra. There's Tata Motors as well in that list. I want to check with you, are you concerned about the possible slowdown in the monsoons and how it could perhaps impact the rural economy and in turn impact some of these spaces like tractors? Would that put a lid on the growth in the near term?
So clearly that's one of the monitorables in terms of potential red flag for overall rural demand as well as for M&M, given close to 45% of revenues on standalone basis comes from tractors. However, if we look at the broader parameters so far, we have a very strong agroeconomic indicators, last 4 years of good monsoon, good water reservoir levels, and good terms of trade for farmers. These things can change if monsoons are really bad. Plus minus 5% is manageable. Beyond that, if it is very bad, then that's clearly one of the red flags for M&M in particular and overall auto sector in general.